Let's take a look at sales discounts for a merchandiser. Earlier, we talked about purchase discounts where we were buying the merchandise and we were receiving a discount for paying early. Now we are selling the merchandise. And here we're going to take a look at where our customers will pay us early. Let's take a look at this example. It says, Elmer's on May 1st, Elmer's Glue Inc. sold $5,000 of glue on credit. The cost of the glue sold was $3,000. The terms of the sale were 2, 10, and 45. So remember, what does this mean? 2, 10, and 45 means we are offering a 2% discount if our customer pays us within 10 days, or the entire amount, the net amount of the invoice, is due to us within 45 days. Remember, this time we're collecting money from our customers. So this is what we are offering our customers. Then it says on 5/11, the customer paid the full amount due. Let's take a look at how we would record this. First, we're going to record the sales transaction. So the two accounts affected by this transaction are accounts receivable and sales revenue. You know that sales revenue gets credited for 5,000 and accounts receivable gets debited for 5,000. We're following the rules of debit and credit. Now remember, for a merchandiser, for every sale, there are two transactions. The second transaction is the reduction of the inventory. So the cost of the glue sold was $3,000, so we need to remove that from inventory and it becomes cost of goods sold. So what are the accounts affected by the transaction? Cost of goods sold and inventory. And we know cost of goods sold is an expense. So we're going to debit cost of goods sold for $3,000 and credit inventory for $3,000. That takes care of the transaction on May 1st. Next transaction's on May 11th. The customer paid the full amount due. The first thing we need to know is this customer paying us within our discount period? Let's take a look. We know that our discount period is we offer 2% if they pay within 10 days. Our merchandise was originally sold on the 1st of May, so 1 plus 10 is 11. So if our customer pays on or before the 11th, we do give them a 2% discount. When did they pay us? They paid us on the 11th of May, so they do get the discount. They are within the discount period. Now let's calculate the discount. The discount is $5,000, which is our selling price, multiplied by the discount, which is 2%, they get a $100 discount. If they get a $100 discount, when they settle the amount in full, how much are they paying us? They're paying us the $5,000 that they owe minus $100 or $4,900. Now let's go and see how we would record this. We know that when they pay, they're going to pay us cash. So we are going to receive cash of $4,900, which means we're going to debit cash $4,900. Next, once they pay us at $4,900, our customer does not owe us anything. So our accounts receivable balance will go down to 0, which means we're going to credit accounts receivable $5,000, bringing the balance of what our customer owes us to 0. Now we got a $5,000 credit for this transaction and a $4,900 debit for this transaction. It is our debit credit rules say that total debits have to equal total credits, so they don't at this point. We're off by $100. We're missing $100 on the debit side. That $100 is equal to the discount that we offered our customer. When we record this discount, we're going to use a separate account called sales discount. So we're short debit 100, so sales discounts gets debited for 100. If you remember, when we were recording purchase discounts, we recorded it using our inventory account, but here we have a separate sales discounts account and we record it in this account. Now let's take a look at the sales discount account. What type of account is it? It is a Contra revenue account. So keep in mind that the sales discount account is a Contra revenue account. the sales discount account has a normal balance that is opposite to that of the revenue account. If you remember, revenue accounts have a normal credit balance, so the contra revenue accounts have a normal debit balance. When we prepare our income statement, we are going to show net sales. Net sales is sales revenue minus sales discounts. So our net sales are $4,900. Again, net sales is sales revenue minus our sales discount. So our net sales are $4,900. Then you will subtract your cost of goods sold, which was $3,000, and then it will give us our gross profit of $1,900. And from that, as you know, we subtract our other expenses to come up with our net income.